The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and welcome to this month's version of the 12 Points webinar series, the Taxman Cometh, Strategies to Minimize your Contribution to the Government in the Form of Taxes. Today, I'm really pleased to have my co-presenter, Jim Keefe from Lee & Crowley with us. Jim is a CPA, and he's going to be educating us today as it relates to current tax laws, some changes, etc. So without further ado, let's kind of go through here. So this is me, Christopher Cahill. I'm a partner at 12 Points Wealth Management. I run the Family Office Services Group, and I specialize in working with affluent clients and on manner of their complex planning needs. As an attorney, certified financial planner, and chartered advisor in philanthropy, I have specific expertise in estate and trust, gift planning, business succession, legacy, and philanthropic planning. I'm really excited to have Jim Keefe with us today. So Jim, why don't you tell us a little bit about yourself and your background, please?
Thank you. Good afternoon, everyone. My name is Jim Keefe. I am a tax director with Lee & Crowley. Been in the industry for over 15 years in public accounting, and prior to that, I spent a number of years at the Massachusetts Department of Revenue. So I'm versed in tax planning, tax compliance for individuals and closely held businesses.
Thanks, Jim. Really appreciate it. And that background is super important. Obviously, being in the DOR gives you a unique insight into the world of taxes. So let's talk about W-2 employees and how they can minimize the impact of personal income taxes.
Okay, thank you. So just to get started, everybody's heard the term pre-tax benefits. That can mean a number of different things. When you look at, for instance, the first item on the list, 401k, your elective deferrals to your 401k come out of pre-tax of your line 1 W-2 taxable wages. So it reduces the wages that are subject to your federal income tax. What a lot of people may not realize is they don't reduce your Social Security taxes or your Medicare taxes. So if you ever spend a couple of minutes looking at your W-2, you might notice a disconnect between line 1 and 5 when you're making elective deferrals. If you're over the FICA limit, you might not see a disconnect. If you're under the FICA limit, which was 147 last year, and it's about 160,000 this year, you'll see the disconnect there also. Couple other pre-tax benefits you can take advantage of to reduce your taxable income: your health savings account, flexible spending account, and child care and withholding changes. With a health savings account, if you participate, if your employer offers what's called a high deductible plan, they can also offer a health savings account in conjunction with that to help you pay for expenses you're going to incur because you have a high deductible plan. Those amounts aren't actually very high for the current year. I believe the high deductible plan starts for a single person at $1,400 and for a family plan at $2,800. So if you have a health insurance plan through your employer and you have a deductible of $2,800, they could offer you a HSA also in conjunction with that. What's great about the HSA is it's a savings account. They're not forcing you to spend it in the current year. So you can contribute up to the annual limits and whether or not you incur actual medical expenses. So for instance, for 23, single person contributing to an HSA, the limit is $3,850. And if you're married filing jointly, the maximum contributions to an HSA is $7,750. Flexible spending account is slightly different. Key difference there between the S's is this is more of a spending versus savings account. You don't have to be in a high deductible plan to take advantage of a flexible spending account, but the downside of that is they want you to spend the money before end of year. So your annual contributions to an HSA for the current year are $3,050. And there are two main types of plans. You can have either a rollover plan, which means if you don't spend all your money before the end of the year in that plan, instead of losing the balance, you can roll over $610 into the following plan year. Or you could have one that offers a grace period instead, which allows you 75 days after year end to spend what's in the account for qualified medical expenses. So if you do have an FSA with your employer, you want to make sure you understand which one of those plans you have so you don't lose any benefits, because any benefits left at the end of the year get turned over to the administrator.
Not a great result, obviously.
Exactly. Right. And then childcare. A lot of employers offer a childcare FSA plan or dependent care plan, which allows you to contribute to dependent care FSA and spend those amounts on qualified dependent care for a child 13 years of age or younger. So if you and your spouse have to work and you need to pay for childcare while you both work, either through a preschool program, qualifying summer programs, etc., you can put aside $5,000 as a family into that dependent care plan and use that to once again pay expenses. And that's another pre-tax deduction. In order to make sure it is being spent for qualified, you will have to file your dependent care form with your tax return and just show that the money was spent. It's not going to generate an additional credit because you would show on the form that you used pre-tax dollars to fund that.
Perfect.
Yep. And then not much in the way of withholding changes. I think for the current year, year over year, everything was pretty consistent. I always tell people, I've had a lot of talks to people, when you get married, pay attention to your withholding, your W-4 form, and make sure if you're in a 2-income house, you're checking that box to make sure everything's adequately withheld. Notice that a lot first year people get married, they don't realize they should be making changes to their W-4. You don't necessarily need to wait to the birth of your first child to update your withholding.
Perfect, thank you. And I would simply say, as it relates to the 401k, obviously what Jim was discussing there was really tax deductible contributions. Most plans today offer Roth options. The difference there being very simply that the tax deductible contribution will grow tax deferred, but will come out in retirement through what's called the required minimum distribution as taxable income to you. So, the current you will love the tax deduction. The future you might not love the taxable income. The other option, as I said, was the Roth, and Roth 401ks are really wonderful for certain people. You're going to have taxable income. Currently, you're not getting a deduction, but you get tax-free growth and withdrawals. So you need to speak with your tax preparer and your financial advisor to figure out what's the best option for you, certainly. And then, on this list here, the thing that I really, really am in favor of is, particularly for wealthier families, is these health savings accounts, to continue to pile money in there and let those assets grow and be utilized for future healthcare needs, I think is really, really critical and important. So with that, let's move forward, Jim, and speak about independent contractors, business owners, certain things that they can do that others might not be able to.
Okay, sounds good. So with your independent contractors, you are technically self-employed. You're running your own business. You're getting a 1099 NEC or miscellaneous from whoever you're contracted with. And how you report that income can be done in a number of different ways. Most people choose the cash method of reporting, which as the income comes in, you recognize it in the current year, and your 1099 that you receive is going to tie back to that in your return. If you operate a business that maybe accrual basis accounting makes more sense, you're recognizing income as you earn it and not necessarily when you collect it. You could be earned, and you typically recognize it as you invoice. Most people, if they're on accrual, we always try to talk to them about why and whether or not a method change to get to cash basis makes more sense. Especially with cash basis, you can manage your expenses at the end of the year. You can prepay certain things, and if you don't exceed a 12-month prepay, you can deduct that all in the current year. Whereas accrual, if you were to pay your entire insurance policy, you're going to have to put that on the balance sheet and amortize that over a 12-month period. So just managing how you recognize income and expenses versus cash to accrual is one option that an independent contractor has. A W-2 employee will never have.
So Jim, question for you there, percentage wise, how many folks do you see operating under accrual versus cash? Just generally.
Very, very minimal. With your independent contractors, I would say I've usually only seen it with 1 or 2 Schedule C filers that are in excess of $1 million of top line revenue. And there's certain industries that they're in that just makes more sense.
Okay, thank you.
All right. Next item that independent contractors have to utilize reducing taxable income is retirement plan options. Whereas when you're an employee, you have the benefit of a 401k plan, 457, whatever your employer offers. You have, as an independent contractor, differences between a SEP plan, a simple IRA, or potentially a solo 401k plan. Mm-hmm. Each plan has different benefits depending on whether you're a sole proprietor working for yourself, or maybe if you have someone working for you. And the limits are much higher. With a SEP or simple, you could potentially put aside as much as almost 60,000, I believe, when you factor everything in, whereas a W-2 employee is limited to 20,000 before catch-up contributions.
Yeah, and what I would say there as well is that we're seeing a lot of business owners, particularly, implement defined benefit plans, good old-fashioned pension plans, maybe in the form of a cash balance plan, which really allows them to increase the overall funding, to your point. So, if you can only put away 20,000 into your retirement plan, give or take, in a 401k, you can add, with a profit share, you can get up to 60, as you indicated, in that neighborhood. But a defined benefit plan can, in many instances, allow you to put away in excess of 100, maybe even 200, depending upon age. Those plans are really powerful for folks that have significant income, significant recurring income, predictable income. Professionals, doctors, attorneys, engineers, architects. Again, folks that have big inflows. So the ability to capture big income tax deductions and save for retirement, especially for folks that might have been maybe a little lax with saving for retirement earlier in their career. So that's something that we've seen a lot of, and we're doing a lot of now, especially in light of increased income taxes coming down the road.
Great, thank you. Next item, health and child reimbursements and spending accounts. Self-employed individuals, rules are slightly different than as a traditional employee, but they still get a benefit from contributing to setting up maybe a health reimbursement arrangement or a spending account. Instead of everything coming pre-tax, you just take an expense on your personal return. So there are some benefits there that you can set up. Some plans, what's nice, you can actually make contributions post year end to the plan as long as it's before the due date of filing your return to get the benefit. So for instance, I had a self-employed owner who made actually some late contributions to an HSA plan because he wasn't until he determined what his tax was that he realized he would get some additional benefit from contributing, and just coding it, having his plan administrator code it as a 2022 contribution.
Nice.
Home office deduction. Big difference there is, under the Tax Cuts and Jobs Act of 2017, all your unreimbursed employee business expenses that W-2 employees used to be able to deduct went away. So there was no deduction that employees can use to offset their income, whereas self-employed 1099 taxpayers are allowed to take a home office deduction as long as you're using the space regularly and exclusively as a home office. If the office space is doing double duty as a place where you pay your bills and a place where you also work, or your kid does his homework in there where you work when you're not working, does it meet the regularly and exclusively test? Most likely not. But if you do have a spot in your home that no one else uses and you use solely for work, then you can take a proportionate share of the expenses to operate that home office against your Schedule C income. And proportionate share can be defined as either, one room out of the total rooms of your house, that ratio, or on square footage. If that room is 100 square feet, you have a 2,500 square foot house, that ratio there. So whatever reasonable ratio, and expenses include utilities, internet, phone, electricity, things of that nature. And then items you use to furnish that office that you're not using for anything else. Printer, fax machine, computer, desk, furniture.
So what happens, Jim, when you go to sell? So you say you've been doing a home office deduction for 20 years and it's now time to downsize and move to Florida or doing whatever you're going to do. How does that impact the sale of
that's a great question. That's a very interesting thing. So a lot of people, in addition to just taking utilities, they'll also depreciate a portion of their home because same thing, depreciation would be ordinary necessary. Depreciation is what's non-qualified use. So if everybody's heard of Section 121 income exclusion, or another name for that is your primary residence exclusion. If you sell your home, you've occupied it for 2 years as a primary residence. If you're married filing jointly, you can exclude up to $500,000 of gain on that property. However, the depreciation is not considered part of that capital gain. There's an add back for that. So it's one of these things where, it's a whipsaw. You get the benefit in the current year, but many years down the road, you may not be able to offset or include that in the capital gain that's excluded.
Right. Excellent. Thank you.
And then last item's an accountable plan. I usually get this question once a year, if not, usually around January when people are doing 1099s. If you're working for someone and you actually get reimbursed by them for expenses and you have to account for those via, expense report, document, receipts, everything, those do not have to be reported on your 1099 because now that becomes the expense of your client you're contracting with. So pay attention to your 1099s. Make sure if you're responsible for accounting for your expenses, they don't throw that on the top. And if they don't throw them on the top, make sure you're not deducting them when you should it. So just pay attention to that.
Perfect. Perfect. Thank you. And now we're going to talk about the world of charitable deductions.
All right. So once again, a lot of things happened back in end of 2017, one of which was the change from an exemption and a deduction to just a very large standard deduction. So for the current year, standard deduction for a couple filing jointly is $25,900. In addition to that, there was a limitation put on state and local taxes. Previously, there was no limitation. It might have been added back when calculating AMT, but you could get to a very large itemized deduction number. Now, where you have taxpayers that maybe don't owe a lot on their mortgage, their itemized deductions aren't exceeding that $25,900 standard deduction. People that have a large mortgage, or in the first couple of years of their mortgage, they might have a $10,000 state and local deduction mixed with a $15,000 mortgage interest expense, and that's going to get you to more than or equal to or more than the standard deduction. So when thinking about that, the question is, okay, how do my charitable contributions come into play? Well, if you're at the low end of the itemized deduction scale and you're making a contribution of, say, $15,000 charitable contribution, if that doesn't get you above the standard deduction, you might not be getting any benefit in the current year. So one strategy is called bunching, where you try to take 2 years worth of charitable contributions and put them into 1 year. So in year one, if you were going to do 7,000 of deductions, or charitable contributions, in year two, you wanted to do maybe 7 or 10, but you don't have mortgage interest and you only have 10,000 of property taxes. You're not getting the full benefit from those because you're going to get that $25,000 standard deduction anyway. So if you're able to, you have the wherewithal to do all that in 1 year, to call it a $14,000 or $17,000 deduction, in addition to your state and local deduction of 10. Now you've pushed yourself above that standard deduction limit, and you would get some additional benefit from those deductions, which you normally would not if you were just did it in separate years. Another option is what's called a donor advised fund. Instead of donating directly to charities, you can work with, plan administrator 12 points to set up a donor advised fund. You make donations to the donor advised fund. It's a qualified charitable organization. So you get the donation in the year you donate to the fund. And then the fund can then distribute the money in future years. So if you don't want to say, put $100,000, $50,000, $20,000, whatever, into a charitable organization in 1 year, you'd rather spread it out over a couple of years. But you see the benefit of getting a deduction, a one-time benefit up front by donating to a donor advised fund and then slowly bleeding that out to the charitable organizations might make sense. Chris, I don't know if you have any.
Yeah, so we do a lot of philanthropic planning with our clients here, certainly, and donor advised funds are a wonderful tool. They provide tremendous flexibility to provide for investments and future contributions. We see it a lot with folks that are in the process of selling a business. They're trying to, capture an income tax deduction, so they'll contribute some assets to a trust or to the donor advised fund. They'll avoid the capital gain, and then they'll pre-fund their future philanthropic inclinations. Really a great strategy. So, we definitely do a lot of that here at 12 Points. I think that's a really wonderful technique and tool. As is being smart with regard to securities. And, if you have appreciated securities, making those gifts rather than simply in cash, you're going to avoid the income tax, the capital gains tax, and be able to maximize the amount of assets to the donors, to the charities is a really excellent strategy as well.
Absolutely. Fully agree that securities, contributing those in conjunction with the donor advised fund is great. A lot of your charitable organizations may not want to deal with receipt of securities. So if you do have some highly appreciated securities, doing that in conjunction with the donor advised fund is a way to really maximize your deduction. You're not recognizing the appreciation in your income, but you're getting the maximum value from the fair market value of those securities.
Perfect. And then this qualified charitable distributions, this has been a real hot topic in 12 Points and for many of our clients. So let's get into this one.
Yeah. So with a qualified charitable distribution, you may have a taxpayer who's 70 and a half or older that wants to make a donation, but for, back to my point on number one, itemized deductions just don't make sense, or it's not going to be sufficient to get it the benefit of an itemized deduction. So you can make a qualified charitable distribution from your IRA. The limit is a $100,000 distribution. And as long as you're 78 and a half, that comes out of income. So you don't have to take it as a deduction. It just reduces your income. So for instance, if you were required to take an RMD, and you had to take a $25,000 RMD during the year, but you really had no benefit from it, you could do it as a QCD, and you're going to get a 1099 that's going to report the $25,000, but you get to back that off the top of in calculating your adjusted gross income. So you don't even need to report a separate deduction for it. And on the benefit, another benefit of this is previously Massachusetts wouldn't, if you didn't itemize, you didn't get the contributions. Massachusetts didn't allow individual filers deductions for charitable contributions. This would still be excluded from Massachusetts taxable income.
Great point. Great point. And this is definitely an area that our wealthier clients that are in the midst of RMDs have looked at as a real boon to just kind of make those charitable gifts that they would have otherwise made. It takes an asset that has got an embedded tax hit in it typically, right? I mean, it's your IRA more often than not. So it's got a embedded income tax with it. So rather than taking that into income, you can just go and meet your philanthropic inclinations. I think that's really an excellent strategy. So we've seen a lot of that. And then, of course, the big thing here to end is just really, what are you trying to accomplish? Anytime we talk about philanthropy and giving, the thing to start before you even pass go is, what's the impact you're trying to get here? So obviously, we can help you model that out in conjunction with Lee and Crowley. They can look at it from the tax perspective. The world of philanthropy is ever changing, but super interesting to us. Now let's take a look at the impact of life events, Jim. So obvious situations, right? Like getting married, having a baby, buying a house. How do these things impact your views of planning and what you do with clients?
Yeah, so couple gets married. Usually if in the lower tax brackets, you're going to see that the marriage brackets are double the single bracket. So you're not going to see too much of a tax hit. You're not going to see a marriage penalty, as the term's been thrown around before. What you do tend to see is when you have couples in the higher tax brackets, the maximum tax bracket for a married family kicks in at, I think, only $60,000 more than a single filer. So potential marriage penalties, if you have a very high income earning household earning more than $600,000, you're going to be pushed into that max 37% bracket. And then other things you need to consider: certain thresholds don't double when you get married. So for instance, if you have someone who's contributing to a Roth, I believe that single filer, the cap is 144, 150,000. When you get married and your two incomes combined, the cap's now 228, so that doesn't double. So you need to be mindful of, what type of contributions are you making to Roth? What other, tax planning have you been doing? And does having that extra income prevent you from going into that, making those deductions, getting those deductions? Another major life event, birth of a child. There's a tax credit available for the birth of a child. However, there are phase-out limitations. Child tax credit is $2,000. When you're a single filer, that starts to phase out over $200,000. Married filing jointly, the phase out is over $400,000. So I had a couple great clients this year that were super excited. They just had a new baby. Everybody's excited, new baby. Then they, of course, they start thinking, all right, now we're going to save more money this year. But depending on their income level, I hope you love that kid because he's not saving you any income this year. And then last item, another major life event is the purchase of a house. People, moving out of the city, deciding to buy a house. The question is, how much do you finance? How much do you buy? Normally, prior to 2017, you could deduct up to 1.1 million in mortgage interest, $1 million, and then up to $100,000 in an equity line, and that would all be deductible as an itemized deduction. Part of once again, the 2017 Tax Cuts and Jobs Act, they limited that. They got rid of the home equity interest, mortgage interest deduction, and they capped the mortgage interest at principal, at $750,000. So only the interest on the first $750,000 is deductible. So just knowing that that $1 million loan on that $1.2 million house might not all be deductible, and you think you're itemizing, you might still be stuck in the standard deduction.
Great point. Really good point. So we got a couple of questions here. I want to make sure that we address them as I'm now seeing them for the first moment. So one of the participants asked whether or not for an FSA healthcare account, there are investment options within the funds. And do we offer FSA healthcare funds? So you can't invest, quote unquote, the FSA funds because the contributions, because as Jim indicated, those are largely spending accounts, not savings accounts. So that's just going to be held in an account pending your accounting and distribution and payment from there. But under HSA's health savings accounts, you can absolutely invest those funds. And that's what we recommend people do, not just accumulate them in the form of cash. Because again, if you're looking to have those assets grow and be there in the future for you, you want to invest them. So HSAs, we definitely invest those for you, can help you with that. There was another question here that I found really interesting, Jim. So this is, somebody wanted to know about what if they volunteered for a nonprofit? Is that considered charitable giving, and is it deductible? So what are your thoughts on that, my friend?
Is it charitable giving to give your time? Absolutely. Is it deductible? No, unfortunately.
Excellent. Thank you.
Yeah, the value of your time, you don't have basis in that. You can't deduct that, unfortunately. If you incur expenses as part of your charitable activities, mileage, there are special rates for mileage. Anything you spend for the charitable organization would be deductible, but unfortunately, donating your time is never a tax deduction.
There we go. So next, we're going to talk about taxes in your investment portfolio. So this is something that certainly was a big topic of discussion last year. So for many people, it's been a long time since there were negatives in portfolios, right? So last year when we had a down year, the last thing you want to do is be printing negative returns in the portfolio performance and handing out tax bills to clients if you can avoid it. So certainly we did a lot of tax loss harvesting. So let's talk about what that is, how that's implemented, and why it's so important, and then we can get into the wash sale rule, etc.
All right. So the basic concept of tax loss harvesting is noticing downs in your portfolio that you want to sell off before year end to generate a capital loss. The tax implications I can walk through. Chris is going to be better able to explain from a financial perspective why you would want to do that. Mm-hmm. But, in terms of your financial strategy, but if he can jump into that in a second, but selling that off can generate a capital loss if you have other capital gains during the year that you want to try and mitigate or avoid. So Chris, I don't know if you want to talk how that fits into a financial strategy.
Yeah, sure. So, hypothetically, say you have a portfolio that has some embedded gains, and you have positions that you would like to have the basis stepped up in. If you've got losses in other positions, so say you own Apple, but you have a loss in Microsoft, and you'd like to reset the basis in Apple, you can capture a gain in Apple and then capture a corresponding loss in an ideal world in Microsoft. Those two would negate one another. You're not going to pay income taxes on the sale of the Apple stock. The loss from Microsoft will wipe that out. And then, theoretically, you can do a couple of things. You can go and invest in a different position, maybe something that looks like Apple, or you could simply wait in cash and then come back and buy it again and reset your basis if you'd like. But it comes down to a portfolio allocation and reallocation discussion. But it's certainly, an important conversation to just be mindful as to your gains, your losses, and basis on positions.
And that kind of touches briefly on our next concept, wash sale rule. If Chris noted, you're selling out of Apple, you're buying Microsoft. You can't rebuy Apple because of this concept of a wash sale rule. The government doesn't want you artificially generating losses just to create a tax savings for yourself. So if you sell something at a loss, you can't buy back into that same similar security equity or security item within a 60-day window. So 30 days before the sale that generated the loss and 30 days after the sale that generated the loss, you can't buy back into that same stock. So you can't go Apple for Apple. That's why he suggested, Apple for Microsoft. And the reason for that is if you sell Apple, take a $20,000 loss, and then you buy it the next day at the exact same price, you still own that same one share of Apple stock. You're no better or worse off, but you can't create it. That deduction shouldn't be, that loss shouldn't be deductible.
Perfect.
And then,
yeah, so I was just simply going to say that the next thing to pay attention to there is really the holding period. So as we say, the capital gains that we were just describing, oftentimes we assume that we're talking long term, but long-term capital gains are only available for things that are held over a year. Anything shorter than that is a short-term gain, which is generally ordinary income based, and that can be a significant difference. So There might be times where you want to generate a short-term gain, but I think you want to be cognizant of that and pay attention to that holding period for sure. Let's talk a little bit about capital gains here as well. So we just touched on it. Jim, what are your views as it relates to anything further in that arena?
Yeah, so capital gains, they define that as, the sale of a capital asset. So question, what is capital asset? Equity, stocks, bonds, cryptocurrency is property. So the sale of cryptocurrency is considered capital in nature. And to your point, holding period matters. The exact wording in the statute is if short-term gain is something that is not held for not more than 1 year. So 1 year or less, call it 1/1/22 to 12/31/22. That's a short-term gain. It's subject to the same ordinary rates your W-2 or self-employment compensation would be subject to. Same progressive tax structure. Long-term gain, anything held more than a year, is subject to a preferential rate. The max rate is going to be dependent on your income. If you're in that max 37% tax bracket, it's going to be a 20% rate. If you're in any bracket except the lowest bracket, it's most likely going to be a 15% tax rate. Other things to consider when it comes to capital gains is the net investment tax, whether you're long or short term, excuse me. If your total income is over $250,000, there might be an additional 3.8% that you have to recognize in tax on those gains. Other item that has had a lot of traction these last couple of years is the sale of 1202 stock. When we're talking about holding periods, if anybody's familiar with 1202 small business stock, holding period for that is 5 years. If the company is a C Corp, has less than 50 million in gross assets on its balance sheet, and it's in a qualified trader business, if you hold that stock for 5 years, if you came in as an employee, received some options, you exercise those options and have been holding the stock for 5 years, you might be able to avoid all gains on that. So I've had a lot of talks with people about that over the past year, which is something I was just thinking about.
Great point. That's a hot topic of discussion for sure, and one thing that you'd really want to be paying attention to if you're going to be contemplating the sale of a business. So really important stuff. And we're going to talk here a little bit about additional tax-deferred savings vehicles. So, we touched on the 401k up front, but let's just talk about traditional IRA funding. What are the deductible limits now in 2023 for somebody that wants to file and fund an IRA?
Deductible limits, are they still $6,500?
I believe it's 65. I'm just going to check it really quick. IRA contribution 2023. Yep, 6,500 if you're under 50 plus another 1,000 if you're over 50. So that's 7,500. Same thing for a Roth if you're under those income thresholds that Jim had referenced before. The SEP IRAs for people that are independent contractors or self-employed, I should say. That's now 66,000 maximum, 25% of compensation up to 66,000, which is that's a nice chunk of change that you can put away there. A lot of self-employed people utilize the SEP funding rules, and then certainly the 401k benefited from a change last year. So again, we're at 22,500 now for basic contributions, and then there's an additional 7,500 for catch-up contributions for those older than 50. So you can put away $30,000 into a 401k. Again, if you were to choose a Roth option, that would be 30,000 of Roth assets, tax-free growth going forward. And we're kind of rounding around the horn here, so let's kind of pivot and talk about, it's not all just income taxes. We did just discuss capital gains. Let's talk about how important that is, and obviously my favorite topic, estate taxes.
Sure. So with, just thinking about capital gains and taxes and estate taxes, when someone passes away, traditionally their assets are included in their estate, and because they could or could not be taxed depending on the exemption amount, there's a step up in basis in those assets. So if you get a step up in basis, you could potentially lower your future capital gains on those assets by leaving them in the estate. So whether or not to put something in a trust early on versus leave it and then have it picked up in the estate could determine how much basis you have and how much capital gains you recognize. Chris, I don't know if you want to jump in and talk in more detail on this.
No, I think that's something that we certainly are constantly paying attention to for our clients. Especially people that own real estate and highly appreciated assets. Highly appreciated or highly depreciated. If you own, say, commercial real estate and you've owned it for a long time, you've depreciated it down to zero. Really makes no sense to sell that property in many instances because you're going to get hit with such a huge capital gains tax. So, in many instances, our recommendation is to continue to hold until you pass. And then the heirs get the step up in basis, at least under current law. We're going to talk in a minute here about some proposals to potentially change that. But yeah, that's an old tried and true method. And then certainly in the world of real estate, like we just described there, that depreciated property with an embedded gain. One way to avoid that, were you so inclined to sell and you really wanted to get out of it, and maybe you found a different property, what we call a replacement property, is Code Section 1031, tax-free exchange, a like-kind exchange. Those are things that we certainly can help you with as well. And again, live and well right now under current law, there are proposals to potentially change that, but definitely things to be paying attention to. So the interchange and intersection of income tax, capital gains tax, and estate taxes, there's a lot at work here. And certainly any questions that you have, by all means reach out to us. And we're going to touch on some recent tax developments here in Massachusetts. The one that I'm sure many of you are waiting to hear about is the Mass Millionaire Surtax. So let's kind of get into the federal stuff and then get down into the Mass stuff, Jim.
Yep. So federally really just applies to your self-employed individuals. 2-year extension on what's called a 461 loss limitation. Anybody who has a business that's throwing off losses for the first couple of years, or at any point if you're throwing off a loss, you can only take 270 of that loss against other non-business loss. So if you have a strong portfolio, interest, dividend income, you can't take more than 270 of that loss to offset your other income. Any additional is just carried forward as a net operating loss to be used in the subsequent year, subject, of course, to the same limitations. And then reduction in bonus depreciation. Most people who have income take Section 179. If, for instance, you have a loss and you want to take bonus starting this year, you can no longer bonus 100% of those depreciable assets, meaning if you buy something for $5,000, you can't take a deduction for $5,000 in the current year. It's you now only get a deduction for 80% of that using this bonus depreciation. So 4,000 of that would be deductible in the current year. And what happens there is it's going to decrease 20% each year till the bonus depreciation rate is down to zero in, I believe, 2026 or after 2026. And then mass developments, biggest one, right? The millionaire surtax effective for this year. So anyone who is expected or projected to have $1 million of Massachusetts taxable income is going to have to pay an additional 4% surtax on that income over $1 million. So for anybody that could be selling a company this year, one of the things we've discussed is installment sale treatment. Can you do anything to get out of, to shift that income over multiple years to get as little into that extra $1 million bracket, 4%, 9% bracket over multiple years? Some people, of course, need the money up front and don't have that option, but to the extent you do, you take back a seller's note and you can spread it out. You could potentially avoid that 4% hit.
Great point.
Sorry.
No, that's a great point. Thank you.
The downside of that, though, is Mass has very strict rules when it comes to installment treatment. They want you to post a bond if you're deferring more than $1 million of gain in an installment sale. So that's something where you want to talk with your tax advisor on, the steps needed to post that bond. And then the other issue is just a recent court case with the Massachusetts Supreme Judicial Court. They determined that Florida S Corp that owns shares of a Massachusetts of a Massachusetts LLC, because it was not unitary business, it was more of a investor. The sale of that Massachusetts LLC did not generate Massachusetts income subject to mass tax, which the reason this is so important is this is contrary to an appellate tax board case from a couple years ago, many years ago, that said the exact opposite, that sale of the LLC units was taxable within the Commonwealth to a non-resident corporation.
Excellent.
So,
excellent. Well, thank you. Thank you. So we're kind of running at time here. I would like to just touch on a couple of real brief topics, Jim, as we discussed before in preparation for this. The Biden administration put out their $7 trillion budget proposal the other day. We're at a point where there's some tax ramifications hidden in there. These things are not by any stretch of the imagination current law or even guaranteed to make it out of the budget process, but certain of these things I think are important to kind of just discuss briefly because it kind of shows where their eye is and where they're focusing on. So, one of the things that they referenced was, potentially increasing the capital gains rate from, the high of 20 to 39.6. What are your thoughts about that, and also potentially removing the step up in basis?
yeah, so fiscally, I don't necessarily think it's a good play. That 39.6, that was those Obama era tax brackets. Everybody wants to spur investment, right? You can't grow if people aren't investing. So to give people a reason to hold their funds in place is why we have these preferential rates.
Right.
So I don't see that gaining any traction. But yeah, it's just one of those things that it's always going to be on the radar.
Yeah, and that's a great point. And there, of course, the next one on my list here is the increased income tax proposal. So they're trying to get back from that 37% to the 39.6 that you just described. Carried interest is always on the radar, certainly is with this administration as well. That's obviously important for private equity fund managers. I don't know that that's generally applicable. But the crypto losses might be something that could potentially be interesting. So, the budget proposal would eliminate the tax break for these crypto investors that allows them to sell assets at a loss, generating tax breaks, and then immediately repurchase. So as we talked about with the wash sale rule on loss harvesting, you can't do that with traditional assets, but under current law, you can do that with the cryptos. They're proposing a restriction on that. So I suspect you have a lot of people that have crypto investments in your book of clients, right?
Yes, absolutely. I saw a lot of crypto trades past couple of years, and this year with everything, you're probably going to see more. And yeah, the real disconnect is crypto isn't considered current security; it's considered property. And the wash sale rule uses the term security, so it's just a matter of aligning those two concepts to prohibit that. That might be the only one I think that gets traction.
Interesting. And then, there's potential proposals to limit the amount of assets in Roth IRA accounts. We'll see about that. The one that really is interesting to me is they're trying to strengthen the tax rules governing estate and gift tax, making it more difficult for wealthy individuals and trusts to avoid taxes. I think that there's been discussion about beefing up the service in Treasury, so that probably will happen in one way, shape, or form. And then lastly, we touched on the 1031 possibility. They really want to get rid of these like-kind exchanges. I don't know that that's going to happen. I mean, the real estate lobby is huge, and it's been such a huge benefit to so many people to allow them to sell property and buy a different property without getting murdered. Otherwise, you're going to just kind of seize up that real estate market. I think that would be a real challenge. And then the last topic here is potential child tax credits. This would be expanding. So this would theoretically be a good thing. They're talking about expanding the child tax credit to $3,600 for children under 6 and $3,000 for children older than that, up from $2,000. So that theoretically could get to work too. Would you agree?
Yes, yeah, that's probably the other one that might have traction.
Perfect. Well, I tell you what, folks, Jim, thank you as always. Great job today. We've gone a little bit longer, but this is a really important topic. You did a wonderful job. Really appreciate your time in the midst of a busy time of year for you. I know that you're trying to get ready for tax prep time, and good luck with that as always. And thanks again. We'll talk soon.
Thanks so much.